Banks kicking off another earnings season. We already saw positive reports from JPMorgan and Wells Fargo on Friday. But what are investors expecting tomorrow from Bank of America and Citi? For more and for the big picture, we're bringing in Saul Martinez, head of U.S. Financials Research at HSBC. Saul, thank you for being with us. So we heard from JPMorgan and Wells Fargo, and the takeaway there seemed to be that net interest income was perhaps not the sort of thing dragging them down that investors might have expected with rates coming down. Is that the big picture, and is that also going to apply for the other money center banks?
All right. Well, thank you for having me. I think that is probably the key debate in the sector right now. And I think that what was encouraging to a lot of investors about JPMorgan and Wells Fargo's results is that there is light at the end of the tunnel for net interest income. And we have been seeing these trends. Deposit cost pressure have been moderating. Both Wells and JPMorgan talked about yield-seeking behavior from depositors moderating. You are seeing the benefit of higher long-end rates filtering through the balance sheet. So with both, with these banks, the question is, do we see a trough in net interest income in the second half or in early 2025? And do we start to see growth again in net interest income next year? That's a critical question, because if you do start to see net interest income growing, which is the biggest revenue component of banks, you start to get an outlook that allows banks to post positive operating leverage and improving EPS momentum and ROTC momentum. So I think in the case of Bank of America, especially tomorrow, that's a key driver. What they say about net interest income in the fourth quarter and into 2025, and whether they continue to see that improving in 2025, is going to be a really important determinant for how the share price reacts.
And so we're now waiting for Goldman and Morgan Stanley as well. What are your expectations for those results?
Yeah, look, I think one of the takeaways from JPMorgan's results was that we had really strong investment banking results, and it's one bank, so your sample size is small, and you have to caution a little bit about drawing conclusions from one report. But JPMorgan had 15% or talked about 15% year-on-year growth in IB about a month ago, and they delivered 31%, highlighting that late in the quarter there was some strong activity. So that could bode well for Morgan Stanley and Goldman Sachs on the investment banking side. We're expecting Goldman to grow investment banking fees 15%. Morgan Stanley a little bit stronger at 41% off of a weaker base. But we think the quarter could be, you could see good activity in debt capital markets. ECM will grow off of a low base, and M&A seems to be improving on the margin. So we do think the capital market side will be good. I think with Goldman, it'll be a messy quarter, but I think it generally reinforces a positive narrative of self-help, improving results in asset and wealth management, and I think that will rule the day tomorrow for them.
As an investor right now, given that sort of strength in investment banking in particular, do you think investors should be more focused on, say, a Morgan Stanley and a Goldman Sachs than some of the other big banks?
Well, that's our call. I mean, we favor the investment banks over the traditional banks. We upgraded Morgan Stanley, in fact, about a week and a half ago for a number of reasons, including we think the earnings revision cycle, which has been negative for a few years, is inflecting. We think the wealth management business is there's some positive signs there in terms of net new fee-generating assets. But the investment banking side is a big piece of that as well. We think they are positively levered to an improving investment banking cycle. We still think we're in the middle innings of that improvement, and that could last a couple of years. Equity issuance and M&A are still below historical averages, and as those improve with rates declining, with limited partners looking to get more liquidity, that also promotes more investment banking activity. And I think Goldman and Morgan Stanley, which we both recommend as buys, are going to be primary beneficiaries. So even though net interest income is improving, and that's a good thing for traditional banks, the revenue outlook we still think is much better for the investment banks.
So what about Citi? That stock has already enjoyed a nice move. It's up about 30% this year. Do you stick with it?
I think you do. We like Citi. We do think that this has a very much a self-help component to it. I think what's important in the results are we seeing dynamics that point to a better profitability outlook over the next couple of years? Can they go from a 6-7% ROTC, which is very low, to closer to 10%? They're guiding to 11 to 12 by 2026. They don't need to get there. They just need to show progress towards that. So what we like about it is that there's a lot of stuff that is in their control. Expenses. Are they on track to reduce their expense base over the next couple of years? We think that they will show progress there. We do also think that net interest income, like the other banks, will start to improve, and that is a good thing as well. But ultimately, they need to start to show better profitability in their underlying businesses: investment banking, wealth management, their cards business. And I do think if they do that, and I think there is a sense of urgency there that I haven't seen in the past, there is a lot of room for multiple expansion and very strong book value growth over the next 2 to 3 years.
A lot to dig into when we get more of these results. Saul, thank you. Appreciate it.
Yeah, happy to be here.